Good afternoon, everyone. I am Lenore Walker, and I'm a care consultant for PSS Kinship Caregivers Program. The program is stationed in the Grandparent Family Apartment Building in the Bronx. The building is owned by PSS and West Side Federation Senior Supportive Housing. It is the first building ever built for kinship caregivers and their families back in 2005. Kinship caregivers are seniors caring for children who are not biologically their own, but are blood related. So it could be a grandmother or grandfather, an aunt, an uncle, or brother, sister, or cousin. The services provided to support kinship families are our youth and young adult services, which offers an after school and a summer program for children ages 6 to 18 years old. We assist with educational support in college and job readiness. For our caregivers, we provide support group, health and wellness training, social activities, one-on-one and family counseling, respites, and supplemental services. All of our services are free of charge. If you or someone you know who is interested in our services or interested in living in our grandparent family apartment building, please contact me at 917-734-8431, or you can email me at lwalker@pssusa.org. Thank you, everyone. Have a great day.
Thank you, Lenore. Again, everybody, if you have any question regarding the services that Lenore just spoke about, you can just send us an email. You can directly send me an email at sjacq@pssusa.org, or of course, you can reach out to Lenore directly. Again, if you have any question, you can add in the chat. So we'll be answering the question at the end. The presentation will be recorded. So if you miss any part of it, or if you know someone that might be interesting of knowing about this information, please share with them. So I'll be posting the website on the chat. Again, without further ado, Antia, you can start.
Yes, okay, I'm going to share my screen. As Shana indicated, my name is Anthea Perkinson, and I am a certified financial planner. I work with a lot of individuals across New York City and Westchester. I work with a lot of retirees and pre-retirees. I'm also the content developer for the Money Made Simple program at PSS. This is a new presentation. I've given it once for the New York Public Library. I am happy to bring it to you here today because this is of growing interest. There are a lot of people who are working beyond traditional retirement age, and there are some significant planning considerations if you decide to work beyond your mid to late 60s. So that's what we're going to talk about today, some planning things that you should be aware of that may be of help. This is an educational presentation. It is not specific investment or tax-related advice. Obviously, please consult your own specialists for particular guidance targeted to your situation. Here is our agenda. We're going to talk about all of the great reasons that continuing to work past age 70, helps you financially. Then we're going to address some of the potential pitfalls of working past age 70 specifically. I'm going to present a case study and some potential planning solutions so you can understand better with that example how these decisions can impact you. I'm going to review both the SHE and the SCREE program for New York City seniors. Then I'm going to address a couple of other tax and income reduction strategies for older workers. And then lastly, I will conclude with an age-based retirement decision timeline, which I hope you will find helpful. There are a lot of good reasons to continue working beyond the traditional age of retirement, which most people assume is age 65. Obviously, one of the biggest is that you will increase your Social Security retirement benefit. If you take your benefit early, most of us know that if you take it at 62 or 65 before you reach what Social Security determines is your full retirement age, FRA. You get a haircut on your Social Security earnings. You get that money back once you pass your full retirement age, but it is haircut if you work and take Social Security at early ages. This no longer applies if you work and take Social Security beyond your full retirement age. So your benefit doesn't decrease, and that's a good thing. The other good thing to know is that every year, Social Security reviews the earnings for anybody who is still working beyond full retirement age, and they do a recalculation. Most of us are aware that your Social Security benefit is based on the highest 35 years of earnings. So if you are continuing to work past full retirement age and you happen to make more this year than you did in one of those 35 years, they will replace it with the current year's earnings. So what happens is that your benefit will drift up. You now have a higher earnings year in there, or perhaps you have a couple of zeros or very low earnings in the 35 that have been previously included. This will improve and increase your Social Security earnings going forward. And do remember that when the cost of living adjustment is made, that is on top of your new higher monthly benefit going forward. And we're all excited that next year, the cost of living adjustment for Social Security is 5.9%, which is enormous, particularly relative to the rather paltry increases that we've seen in previous recent years. The other great impact of continuing to work is that you will continue to have the opportunity to add to your 403B or 401k retirement savings plans. Now, most people know that a 403B is a retirement savings plan if you are in government or nonprofit work, and it corresponds to the 401k plan, which is the retirement savings plan for public companies. Continuing to contribute has wonderful benefits. Obviously, you save taxes on your current earnings, but you are also able to delay required minimum distribution withdrawals from your active 401k account or 403b. The traditional 403b and 401k retirement plans, as you are putting money into it, you lower your currently taxable income. Remember, some people have access to a Roth 403b or 401k retirement plan. That money is contributed after tax, so you don't get an immediate tax benefit, but your contributions, your investments in that account, grow tax-free forever. So when you take them out in later years, you don't have to pay income tax on them. Note that word warning there. You see that here on the screen. That warning is to remind people that Roth 403b and 401k plans are governed by 401k and 403b rules rather than Roth rules. And what I mean to emphasize is that if you leave your money in the Roth 403b or 401k beyond the age that you are required to take minimum distributions, RMD withdrawals, the Roth side of the account will be subject to that as well, because it's governed by the 401k and 403 rules. To escape this, when you stop working, you want to remember to roll over your Roth 403b or 401k into a freestanding Roth IRA. Then you don't have to take RMD withdrawals, and it can continue to grow tax-free. Another bit of good news for people working beyond traditional age, you can continue to make IRA contributions. Under the Secure Act, they got rid of the maximum age. It used to be that you could only make IRA contributions until you actually had to turn around and take these required minimum distributions. That age was 70 and a half. Now there's no age limit. So, honestly, if you wanted to work till 90, you could make IRA contributions. You only need earned income. And just a reminder, earned income is income from a job, whether it's a W-2 job or a 1099 or from active business income. You can't make an IRA contribution based on passive income, which consists of things like dividends and interest, real estate rents, things like that. So if you're working, you are eligible regardless of age. The Secure Act introduced this new RMD withdrawal age. It is now age 72, unless you turn 70 and a half before January 1st, 2020. Then you're operating under the old rules. It does lead to this very funny situation now under the Secure Act that people over age 70 and a half or 72 still working can contribute to an IRA while having to make an RMD withdrawal at the same time. So you got money going in and money being forced out. Now, one thing I will point out, if you are of an age where you are required to make RMD withdrawals, continuing to work means your 401k or 403b is not subject to those withdrawals. Your other accounts, your outside IRA, old retirement savings plans at prior employers would be required to have an RMD distribution. Another great benefit of continuing to work is you enjoy continued access to other employer benefits. So for example, group life insurance with no medical underwriting. I don't know if you have attempted to get life insurance as an older person, but it is very expensive and not an easy undertaking. They have very strict underwriting requirements, and it is a bit of a hassle. If you have a job where you can get a base amount of life insurance, which is very typical as an employee benefit, it's usually 2 times annual income. You're often given an opportunity to buy supplemental life insurance, which at a group rate is very inexpensive, and you don't have to go through the medical tests. Another benefit, many employees are eligible for dental and vision insurance plans. This is not something yet covered by Medicare, so this could be a great way to help you save money for that type of care. Pre-tax flexible spending plans. These are plans where you're able to contribute money pre-tax out of your paycheck and spend that money on medical costs, whether it is deductibles, equipment, or dependent care. And most people think of dependent care is solely for children, but there are many people who have an ailing spouse or family member who requires in-home care, whether it's a visiting nurse, maybe it's an adult daycare center because you're working and somebody has to, make sure that this person is being looked after, gets lunch, etc. Those expenses are eligible for flexible spending plan deductions. The 2021 dependent care flexible spending account cap has been increased dramatically. This is a big deal and not a lot of people are looking at it. Used to be you could only sock away $5,000, but now you could actually put away as much as $10,500 this year. Other benefits that people enjoy through their employers, legal plans, shopping benefits, travel benefits, museum passes. These are all great reasons for continuing to go to work. With the legal plans, I will point out, I've had a number of clients who have had access to legal plans pay for it. It's generally very inexpensive on a pre-tax basis, but then they don't utilize it. And if you're putting off getting your will done, for example, or updated, or putting together your living will, your healthcare proxy, all of that stuff, don't wait. You're paying for it. You will get it done for you either for nothing because you're part of this plan or at a greatly discounted rate. So take advantage of that. Don't just pay for it and never use it. Another great impact of continuing to work, your other savings can be increased. Obviously, the more time that you're working, assuming that you're covering your bills, you have a chance to continue to add to your bank savings account or buy more bank CDs. You can make more contributions into your taxable brokerage account. And the same thing for any fixed or variable deferred annuities. You can continue to add to these. Fewer years in retirement because you are working past 70 means that ultimately you will need a smaller nest egg. Your money will be used and spent to cover your expenses for fewer years. Continuing to work, continuing to not spend that money, to continue to accumulate, means that you've got more interest compounding periods. So you'll add to it and it will grow at interest. Same thing with your taxable brokerage account. More time to contribute and more time for that balance to grow and compound. Same with the tax-deferred fixed and variable annuities. So if your current paycheck covers all of your living expenses, all of your current savings can be left to compound and grow. Now, I looked for an illustration. I wanted to show in a picture, in a graph, this concept of compounding, what a lot of professionals refer to as the time value of money. So the more time you have, the more compounding periods you have, the more money you will have in the end. And this was the simplest that I could find that illustrates a second point, which is that those who retire later, continue to work and save and put off retirement, actually get to spend more money when they get there. So here we have an example. If you look at the orange line, here's somebody who stops saving and retires and begins to spend their savings at age 55. And you will see that having saved a little bit over $500,000, that's this axis over here, but retiring as early as 55, they are restricted to only spending $18,000, which is 3.4% of their total savings, if their money is to last past 70. For somebody who represents the green line, they retire at 60, stop saving, start spending, they get to spend a little bit more, 3.7 of their higher balance. They're coming in around 800,000. And to make that money last, they can spend a little bit more, but not hugely more. The next person is the purple line. They stop saving and start spending at the traditional age of 65. Here you see they can spend 4%. They've got about $1.2 million. They can spend $47,000 a year. The person who waits to retire till 70 is able to spend a lot more. Their withdrawal rate is effectively 4.6%, and they are able to spend close to $80,000 a year. They'll be spending it over a shorter lifespan, so they can afford to do this. So it does illustrate these concepts of continuing to work and the benefits of accumulating more and being able to spend more at your older ages. In addition to financial security, work has other benefits. It gives us routine, structures our day, and does offer some element of social interaction. I talk to a lot of people who are eager to retire. They just can't wait. They want to retire early. And after we talk through the financial implications, I do ask them, what do you plan to do with all that newfound free time? Who are you going to have lunch with? How are you going to structure your day? If you are bored, you have a chance of failing retirement, of being very unhappy with a lack of a job and a lack of that normal, ordinary routine of going to work every day. So there is something important about having that structure and that routine that has to be reinvented once we stop working. Now I'd like to pivot and talk about some of the potential pitfalls of working past 70. The number one is related to Medicare. And there is a huge penalty if you simply forget to sign up for Medicare Part A. You don't actually have to go on to Medicare Part A if you are working and have employee medical insurance, but you have to sign up. If you fail to, you're going to have a permanent premium penalty. And most employers are all over this. And as you approach this magical age of 65, even if you fully intend to continue working, they'll be tap dancing on you to make sure you call Social Security Administration and register. Maybe not take it, but just be on the books that you signed up. People who are self-employed sometimes simply forget about this. They've been paying for private medical insurance forever, or they've been on a spouse's plan forever. They sail through this age, and now when they go and they need it, it's going to cost them quite a bit more. So the other thing to consider, if you decide to work past your full retirement age and not take Social Security until 70, which is the last claiming age, you're going to have to pay your Medicare premiums, your Part B and D, directly, rather than have them deducted from your Social Security payment, which is what a lot of people do when they retire because that's pretty convenient. Medicare.gov has a lot of different payment options. They are very easy to work with. You can even pay these premiums using a credit card. If you are a rewards point junkie, that's easy to do, or you can set up a bank draft, but you have to proactively make arrangements for those payments. The other thing to think about, after age 70 and a half or age 72, whichever you fall under, if you are still working, your paycheck plus your Social Security benefit, plus your required minimum distributions from your IRAs, plus your dividends and interest, plus any pension you may receive from a job or a prior job or a deceased spouse, could push you into IRMA. This is something to be very aware of. People are really confused about IRMA. So let's talk about what that is. IRMA stands for Income Related Monthly Adjustment Amount. And basically what it is a special assessment for people who are higher income. So it's an extra added on to the regular premium for providing the Medicare Part B and Part D. So it's on top of the standard premium amounts. Most people do not pay for Part A of Medicare. And that's because as they're working, they've paid Medicare taxes for over 10 years. There are people whose job functions aren't subject to Medicare taxes. Some of the old railroad programs didn't kick into Medicare or Social Security. If they turn around and their spouse now needs Medicare coverage, they will have to pay $471 a month for it. People who didn't work very long for one reason or another, they may have to pay additionally, depending on the number of quarters. But as I said earlier, most people have paid in for 10 years, minimum of 10 years, and don't have to pay for Part A. The standard premium for Part B in 2021 is $148.50. Whether you get to pay the standard premium depends on your magi. All right, and let's look what this term means and what this could cost. Modified, MAGI stands for Modified Adjusted Gross Income. Most of us are familiar with the term adjusted gross income. It comes from our tax returns. To get to Modified Adjusted Gross Income, there's an adding back process where the Medicare Social Security Administration adds back contributions that someone may have made to an IRA. Deducted it from their income, it gets added back as though it hadn't happened. Same thing with alimony payments. These are for divorces prior to 2019, but you don't get to deduct this from your eligible income right now. Same thing if you're paying for self-employed health insurance payments. It's a deduction on your tax return, but not when we're figuring out whether we're subject to IRMA. And the same thing with half of your self-employment taxes paid. Now let's look at what the implications of this are. This is the grid, the schedule for IRMA for 2021. So it's broken down by tax filing status. The two tax filing statuses are either you're single, married, filing jointly. And your MAGI is between $88,001, $111,000. Here is what the IRMA assessments are. So you pay the $148.50, which is standard, but your MAGI falls in this band. You get the assessment of another $59.40 a month, plus another $12.30 for your drug coverage, Part D. You can see that these go up, the bands get higher. If you happen to fall in here, which is not, crazy, there are a lot of people in the New York metro area whose modified adjusted gross income would fall in that range. It effectively doubles the cost of your Medicare coverage on a monthly basis. For married couples, slightly different ranges, but the same impact. And you can find, because I've run into them, 2 retired teachers who, by the time they are taking required minimum distributions, they got a little part-time work or some freelancing activity, they fall into this band, not knowing. And now for each of them, they're paying this additional $148.50 plus the additional $31.80. This can add up and can be quite a monthly, bitter pill to swallow on a monthly basis. To illustrate the impact of IRMA, I have a case study. I'd like to present to you Estelle. She is single. She is age 73. She's presently still working full-time, and she earns $65,000 a year. At the end of the year, and this is a very, very simple illustration, so I don't have all the tax withholding information. I'm using whole numbers here just to illustrate the concept. She contributes $10,000 to her company's 401k plan. So her taxable income, $55,000. She has an IRA outside of her plan. It had $360,000 in it, $1,231 the year before. So her RMD for this year is $14,575. The taxable portion, oops, forgive me, I moved ahead. Taxable portion of her Social Security retirement benefits, because of course she's over age 70, she has to take these, $24,735. She's got some rental income, gets net $16,600, and then from ordinary dividends and interest on savings in the bank, she has another $128 in income. So look at this. She is a single person. These sources of income, she falls into that second band of the IRMA schedule. So she's going to pay the standard $148 plus IRMA of $148.60 plus another $31.80 for her additional assessment on Part D. So her monthly Medicare cost is going to be $328.90 plus whatever elected drug plan she takes. That's a lot of money. And that's why you hear people complaining that Medicare, they thought it would be cheap. It's not cheap. It's because of all of these additional sources of money pushing you into this IRMA schedule. So what could we do to help her out? How can we address IRMA and fix this for her? Well, the first thing she could do, she's only putting $10,000 into her 401k plan. If she just elected to take the max, contribute the max, she'll save more in taxes anyway. If she's got savings, which it appears she does, she doesn't need every nickel of her take-home pay, she could reduce her W-2 income to $39,000. Now she comes in after, all of these remain the same, but her taxable income, $95,038. This pushes her down one bracket in IRMA. So rather than doubling her base premium, her penalty is really only $59.40 plus $12.30 for Part D. So now we've gotten her Medicare expenses down to $220 plus her elected drug plan, whatever that costs. So she's saving more than $100 a month. Is there more we could do for her? Why, yes, there is. There is nothing likely stopping her from, since she's still working, rolling her outside IRA into her employer's 401k plan. Most plan administrators are perfectly happy to take this money. If she's planning to work there for a few more years, this would save her the hassle and expense of continuing the RMDs that she now has to take. So we eliminate that. That was almost $15,000. So now we're contributing the max. We're not doing the RMDs. She's got her Social Security here. We've got the rental income. She's under the $88,000 IRMA income threshold. So now all she has to pay for her Medicare insurance is $148.50 a month, plus for her elected drug plan. Huge savings. And I'm sure she would feel that it is much more under control. Let's learn a little bit more about our spokesmodel, Estelle. Here is a little bit more about her backstory. She's currently age 73. Turns out she was widowed 5 years ago, and that the $360,000 IRA balance mostly came from her deceased husband's retirement savings plan. When she rolls over the IRA into her 401k, her new balance is $390,000. So she only had $30,000 in her own retirement savings. She relied on him to manage the finances, to worry about financial security and retirement. What she didn't count on was that he would die so young. She also relied on him to manage the rental apartment. This was his bachelor pad before they got married, and he held on to it, dealt with the tenants, managed the rental payments and any upgrades and all of that. And she's not that keen on it. She doesn't want to deal with tenants. And she knows at this point, the apartment needs some renovations. It's more of a hassle, particularly since she's working full time. She's in the great position that her mortgage is paid off, but she's very worried about her monthly maintenance. The fee keeps going up. If you live in a condo or co-op in New York City, this is a common complaint. The fees keep going up. Could she be eligible for New York City's SHE program, which could help her with this monthly maintenance fee cost? Well, let's take a look at the program. SHE stands for Senior Citizens Homeowners Exemption, and it's a program designed for property owners age 65 and older. It offers a reduction in New York City real property tax, so between 5% of that tax to 50% of that tax based on income. The household income cap for 2021 is $58,399. The way it works is you apply by March 15th for eligibility July 1. And if you are eligible, you will get a rebate as a credit on your maintenance fee invoice. If you're eligible for 5%, it'll be a 5% rebate. If you're eligible for 50%, it's a 50% rebate. And you can find out more and get the forms by calling 311 or visiting the NewYorkCity.gov website for the application. The program requires ongoing income verification, which is done every other year. This is what the application asks. This is just a screenshot of the actual form. And there's a lot of confusion about how the program works because what they consider income is not the same as the way Medicare defines income and the way other income-related tax benefits work. So let's go through it so that you're clear on how this might benefit you. A lot of people are eligible for this and don't know it. They think they're ineligible based on their sources of income. So let's look at what income they count. Well, obviously, your full Social Security amount. So it's not 85% that we are taxed on. It is the full amount gets claimed as income on the SHE application. All dividends, whether you spend them or reinvest them, they get counted. Same thing with capital gains. And these capital gains, if it's distributed by your mutual funds, which will be happening for us soon, that gets counted. If you sell something at a gain, that too gets counted. If you have payments from a pension plan or a retirement plan, that gets counted. Now look at this, item F, IRA and annuity earnings, not withdrawals. So this is not money you're taking out of your retirement savings. It's how much did the money earn over the counted year. Salaries and wages, interest, including non-taxable interest. So if you have muni bonds that are triple tax-free, that gets counted for SHE. Trust income, farming income, net business income, unemployment insurance. Now, let's look at what doesn't count as income. IRA distributions. So a lot of older New Yorkers have RMDs. It's taxable, obviously, but the RMD withdrawals are not counted as income on your SHE application. Reverse mortgage proceeds, more rare in New York, but here too, that wouldn't count, and this might be a good benefit. Return of capital, gifts, inheritance, etc. Now that is how the add up for income works. Let's spend just a minute on how they adjust income. You'll see over here in yellow that I've included details on this. The Department of Finance for New York administers this program, and they have counselors to help you fill out the application and address questions. They take your total income, so they have income from all sources, A through M here. They take out what you've paid in federal income tax. So if you've had, for example, a salary and taxes withheld, they adjust your income down for that. Any New York and New York City tax, your FICA contributions for Social Security and Medicare, that goes. Your Medicare or Advantage premiums, that gets added to your unreimbursed medical expenses. And this is important. A lot of people confuse this particular paragraph where it says this does not include unpaid expense bills. If you filed a 1040 and completed a Schedule A, we'll use the information on the schedule for paid unreimbursed medical or prescription expenses. A lot of people read that and say, oh, that means I have to itemize on my tax return and I take the standard deduction, I must not be eligible. No, it just means that they will use that information if you happen to itemize. If you are a standard deduction person, you submit your own copies of bills of what you've paid for and what you paid for your Medicare coverage. This can be a significant deduction and adjustment to income that might make you eligible for this particular program. It's worth a look. So let's go back to Estelle and see if we can get her into this program. We're planning ahead. She's now age 76. She retired at the end of the year that she turned 75, so she no longer has W-2 income. She does have RMDs. Now she's got to take an RMD on the entire 401k plan. Last year, 12/31, the plan balance was $456,000. And now on her new older age, her factor is 22.9. So she's got to take out almost $20,000 a year. She has $25,000 now in Social Security. This is the taxable portion. She got rid of that apartment. She was just done with it. So she was able to sell it for $825,000. And after taxes and fees, she ended up with $590,000. So presently sitting in cash. She got this done toward the end of last tax year. Ordinary dividends and interest, particularly with that big balance sitting in the bank, up to $929,000. So not working, she is bringing in $46,576. She's not subject to IRMA, so that's great news. Now she wants to see, is she eligible for SHE? Well, remember that we have to add back the 15% because we have to use the full Social Security benefit. So we add that back, excuse me. And now her income, when we add back the Social Security, count for the full 30,000, is $51,118. We deduct the 19 that she took out because remember, RMDs don't get counted, but we have to turn around and add the amount that her 401k grew last year, which was more or less the same amount, 20,000. So no IRMA, and she is eligible for SHE, which will lower her apartment maintenance. Excuse me. When she's 78 and she has to reapply and verify her income, it looks like this. W-2, nothing. RMDs don't count. Social Security, here's her total check. Ordinary dividends and interest, after spending $90,000 from the apartment sale proceeds, she's got the $500,000 now invested in bonds and money markets, the taxable brokerage account. So it's earning $15,000 a year. So her current total income under the SHE program is $46,499. So based on this, she actually gets the highest possible reduction in her real estate taxes under the SHE program. If her income creeped higher, we'd start digging deeper into her medical expenses so that those adjustments could be made and keep her eligible for the program. There is an equivalent program for senior citizens who rent in New York City. You've heard the term, I think, because this is their branding slogan, freeze the rent. It's designed for seniors age 62 and older who are on the lease of a rent-controlled, rent-regulated, or rent-stabilized apartment. The combined income of everyone living in the apartment must be less than $50,000, and at least a third of net household income is spent on rent. Again, you can find out more information and get the application by calling 311 or visiting the NewYorkCity.gov website. The application requires proof of age, proof of income, and proof of rent based on the eligible apartment type. It's renewed either every year, every 2 years, depending on whether you renew your lease every year or every 2 years. And this can be a real godsend for a lot of seniors in New York City who are really dependent solely on Social Security income and very modest pension amounts. So this can be a great program to look into and maybe have friends look into it as well. What they look for is very similar to the SHE program. So they are going to look at all of your tax returns. They can examine sources of income. And remember that like with SHE, it's IRA earnings, not IRA withdrawals. So RMDs don't count. Same thing, annuities. So if you have an annuity and you're taking distributions from it, they're only worried about what that earned over the year, not what you're taking out. Okay. Let's turn now to a couple of tax management and tax reduction strategies that are really designed and great for older Americans and older New Yorkers. We have the Qualified Charitable Distribution called the QCD. And what this allows taxpayers to do is to direct either a full or a partial RMD withdrawal to be paid directly to a designated charity. And a charity is a 501c3 organization, any entity where you could take a tax deduction for making a contribution. So what this does for people is eliminates the same dollar amount of taxable income. So let's do a simple example. Say the RMD amount on your qualified funds for 2022 is $20,000. You want less taxable income for a variety of reasons. You decide to make a QCD of 5,000 out of that 20, and you direct it to your alma mater, your former college. Now, when you do your taxes, you're only paying taxes on 15,000 from your RMD, and that could help you avoid IRMA. So this is a strategy that could be very material if you're trying not to creep up in that penalty premium bracket. Another potential strategy for managing the tax bite is a qualified longevity annuity contract, referred to as a Culac. And what this allows people to do who have retirement savings and really want to protect them from RMD withdrawals too soon, if they are concerned about either the tax bite or they're concerned that having to take RMDs, particularly if they're still working to accumulate more assets, feels counterproductive. We want to, preserve our money. They can take the lesser of $135,000 or 25% of your combined balances from your IRAs, your 401ks, old 403bs, whatever you have out there in savings, and you can roll this money tax deferred into this qualified longevity annuity contract. This means that you can defer taking income from the contract. So you're not paying the RMDs on it. You're not taking money out in a required minimum distribution, so you're not paying taxes on it. This $135,000, if you qualify for that amount, gets to sit in this annuity contract, and you can defer taking taxable income out of it all the way up until age 85. You can access it sooner if you need it. When it comes out, you turn on the income payments. They, like taking a withdrawal from your IRA, are 100% taxable, but you have this opportunity to defer it until later years. The way Culacs are designed, when you sign up, it is a lifetime guarantee. So they will give you what's called an illustration of what your income would be if you held it for 10 years in that particular insurance company's Culac contract. They'll tell you to the penny, you will get for this $135,000 to $2,300 a month, whatever it is. You will get that for the rest of your life. Many of these contracts, particularly in New York, have the opportunity to give owners the opportunity to take the money out 5 years sooner and to name a beneficiary for part of that period. The planning benefit for looking at these and considering whether they are right for you is they lower the tax bill for your current RMDs from your qualified funds, and they create a stream of future taxable income that you can't outlive. So that can be pretty compelling. I mentioned that I would offer a decision-making timeline, and here we are. We'll go through it together. So age 65, the critical age for signing up for Medicare Part A. Whether you take it or not, you gotta sign up. So be certain to make that phone call into Social Security and get that done. We didn't talk about long-term care insurance, but I want you to know if you're located in New York, more and more, age 65 is the last age at which you can apply for long-term care insurance if you're looking at a traditional LTC policy. This just reflects the underwriting history and challenges of this particular type of insurance contract. So just file that away. If you're interested, that's when you need to make that decision. At age 70, This is the latest start for Social Security. And if you are in a position to wait till age 70 to take your Social Security, you will be getting your biggest possible check. And for those who are turning 70 this year and starting their Social Security, it's going to be great when you get that giant cost of living increase on this biggest possible monthly check for next year. Age 70 and a half, if you turned age 70 and a half by January 1, 2020, you are currently subject to RMDs, required minimum distributions from IRAs, qualified accounts, outside your current employer's 401k plan. Remember my warning about Roth 401k and 403b accounts. If you stop working and you have money in a Roth 401k, 403b plan, you're over age 70 and a half or age 72, you have to make RMDs from the Roth portion as well, unless you roll it into a Roth IRA outside the plan. This is the same information here for age 72. Going ahead to age 75. If you want to get the maximum of 10 years of deferred income, so you're looking to take money out of your qualified accounts now to purchase this Culac with the idea that you'll let it sit in this annuity for 10 years so you can get the biggest possible check at that time that you can outlive, you need to purchase it by age 75. Not that you can't wait, you just won't then have 10 years, because at age 85, that's the last age that you can defer income payments. They have to start distributing at that time. So I hope this has been a helpful overview of planning considerations for older workers. I am going to look at the chat and see if we have any questions that I can help people with. Any questions, Shana?
I don't see any questions. I guess everything was very clear for everybody. But again, if you miss any part of it, or you think this information might be beneficial for somebody in your life, some friends and family member, please share with them. I also put the resources link on the chat. Thank you, Antia. So I think we finished strong this year. So I don't know if we're gonna schedule anything for December, but if anything, we're going to start again strong next year with other more exciting topic for the community, right?
Yes.
So thank you again, everybody. And without any other questions, so we're gonna end the session, and have a great afternoon, everybody. Thank you again, Lenore.
You're welcome. Bye-bye,
Bye,
everyone.
Bye-bye
Thank
now.
you.